Good morning, guys, and welcome to another episode of the mentorship program. Today we'll be talking on the second episode of the topic liquidity and bias, and it will just be the practical aspect of it all, where we just walk off the chart. If you haven't watched the last video, please do well to watch it before seeing this, because that will even refine and also make you understand what is being said here more. But no, I understand you want to watch this as quickly as possible, so let's get to it. This is the DXY chart. The very first thing you look at whenever you see a chart is look at the pair. This is the DXY, this is the dollar index. Then look at the time frame. This is a weekly time frame. That means each and every candle on this chart represents 1 week. Each and every green or red candle represents 1 week. The trading or the price action that happened within the week, within each week. So that's what each candle represents. So since we'll be talking about the dollar index, I'll be fine-tuning this from 2021. We'll be taking this from 2021 till 2024. Prior to the beginning of 2021, as of September 21st, 2020, we saw the dollar being bearish, going all the way down, shedding off. And then as of 4th of January 2021, this is a particular leg that we'll be anticipating a retracement of it. And that's what happened. This is a particular leg from this top at 21st of September 2020 to this low at 4th of January 2021, this particular point. And this particular point, these are points where we expect. This is a particular price length, also called a daily range. This is a range where we expect, okay, price should gravitate either to the buy side or to the sell side. So with that being said, this will become a sell side liquidity, while this will become a buy side liquidity. So these are buy side liquidity, these are sell side liquidity. The top of the price leg is a buy side liquidity, the low of the price leg is a sell side liquidity. So these are external range liquidities now. External range. Anything above here is external range. Anything below here is external range. Now we expect a retracement, and we started having that. And then I told you the last time that a true retracement is the one that goes at least 50% of that price leg. So if you put your fib on this, the halfway point of this is this 0.5, and then it goes above 0.5 to enter this premium. We are still going to talk on premium, equilibrium, and discounts later. So enter this premium, and entering this premium now, we should expect, if we are still going to see more downtrend, we should expect sell-offs from that premium. So since that would be the case, the market started gravitating to the premium, entered premium, retrace this leg, and then we expect more expansion to the downside, right? That would be it. And so they started expanding to the downside. Sell orders will be placed. But then market makers don't want to see this low being breached. So after expanding to the downside, all of this, if I'm still on this trade, if I'm expecting I'll be expecting the dollar to go down throughout all of this. So all of this will be something I'll expect to be looking for sales. But immediately we take out this low, and then we start gravitating up looking for this. And then we get this, immediately we get this high. This changes. because you expect, okay, if they take out this particular low here, this becomes the new daily range, buy side liquidity, and then anything they form will be the sell side liquidity, where we expect a retracement again for more down moves. But now taking out this high, going all the way back to take out this buy side liquidity, this ERL, external range liquidity, the market has shifted. The market has shifted into bullishness. So where will be what I'll keep expecting for the week? What I'll then keep expecting for the week is targeting the highs that we shed down, all the swing highs that we had before, all of this, then this. That will be the targets. Immediately we take this out, that will be, I'll be expecting longs to take this first. That's the low hanging fruit, and then this, and then this. These are the swing guys. So with that being said, if you look at our CRR from here straight up to here, and then straight down here without taking out this low, and then they start gravitating, go down a bit, form price contractions, and then retrace, and then form all of this. With this price leg, I expect another retracement, and then after the retracement, a new high should be produced, then a retracement, and then a new high, retracement again, then like that. That's how the market works. The market don't just keep expanding up, and they don't just keep expanding down. They expand, then retrace, expand, retrace for every trend. Expand, retrace. So with that being said, after they failed to take out this low here, this particular sell side liquidity, after they failed to take it out and then reversed this whole move, reversed it here, taking it out, this becomes the next point of liquidity. There's another buy side liquidity there, and then here, let me make it a bit thinner so it will get there. Sorry. There's also another buy side liquidity there, and then something around there. So those things will become, those highs here will become a point of reference for me, because the market has showed its intention of looking for highs now, looking for swing highs, looking for buy side liquidity. So on the same vein, to trade this becomes a price leg, the retracement leg. A new high is formed, then that becomes a new dealing range or a price leg. The retracement leg here, then a new high is formed to take out that buy side liquidity, retracement there, then another high. That is how it works. There is no Aikinashi, Ichimoku, anything that I have been learning. No, this is just how it works. And how will I now form my bias with this being said? After this has happened, and even to talk by hindsight, if they come back to take as high as this, that will start drawing me to the conclusion that this will most likely be smoothed, this particular buy side liquidity, after they take this out. And with that, they retraced without taking out this low. This is all they did here. From here to here, all they did was make a big giant expansion, then slight retracement, again slight retracement, then spread it out. That's all they did here. And with that being said, my bias and the long-term view will switch from being bearish when we are going down here to being bullish. That's how your bias change. Bias is not static that we must keep seeing lows. No. And since it will switch from being bearish to being bullish, all of my target, the way I'll be trading going forward will be to look for longs to take out this buy side liquidity. Then looking for longs again to take out this buy side liquidity, with the premise of also putting the idea of CERR, that's consolidation, expansion, retracement and reversal principle in. After every expansion leg, I will expect a retracement. I won't expect a reversal because we have another buy side liquidity we are targeting. I will expect a retracement, then more expansion, then a retracement, then more expansion to that buy side liquidity. And if we have more, after the expansion, I will expect another retracement, then more expansion to that buy side liquidity again. That is how it works. That is how I form the weekly bias. But there will be some weeks where our target sells in the sense that I expect them to come and balance and imbalance, things like this. This is an imbalance in form of a fair value gap. I'll get to that topic, and you can also check out ICT, the create content of that. I learned from there too. Balance and imbalance, which they did. And all this, when traders start seeing this particular move going down, they start thinking, oh, this is washing away, this is going crazily down. Whereas this is just a retracement leg for more expansion. For smart money, how will smart money internalize this? If smart money are targeting this particular liquidity point, every retracement leg, they will add positions. If this is their terminus, if this is where they want to stop, every retracement leg here, they will be adding a position. Here, they will be adding a position. This big one, they will be adding a position. After that, this one, they will be adding a position. And then watch it run all the way here. It's as easy as that. Every retracement, they will keep adding positions. That is how it works. That is how you can use liquidity to form a bias. Where is price likely to draw to next? And with that being said, you have gotten all of that. Throughout 2022, it was all an uptrend till they got to that liquidity point. And from there, they expanded upwards. After expanding upwards, where you now form a bias next to be. Rebalancing and imbalance now will come in the form of this. They entered an imbalance. This fair value gap is an imbalance. This is a BC. We'll still get to that topic. They entered an imbalance, bounced out of it. My next point of call will be seeing this I get smoked. After this I get smoked, retracement, and then seeing what the next I get smoked. Why? Because they keep respecting each bullish trend, bullish apparatus. They keep respecting it. Expansion, retracement, then more expansion, then retracement. then another expansion. This will be the next point of call. And then the retracement leg, then more expansion outwards. This should be a retracement leg then to send us in. Then remember, from what happened when we started, this now happened at the buy side. After this retracement, we should see more expansion upwards to the upside. But this was protected now. This was protected, and then we now saw the reversal of that retracement. Market structure shift occurred. Market structure shift occurred. If you are not comfortable with that, you can sit your hands down here and wait for this. But obviously, if you go to the lower time frame, the daily, this will get clearer, way clearer. So MSS occurred here. And what's market structure shift? Market structure shift is used to signify change in trend. Change in trend. Maybe market shifting from bullish to bearish, or from bearish to bullish, from an uptrend to a downtrend, or from a downtrend to an uptrend. So, if I draw the pathway out, this expansion leg, the retracement of it, this expansion, the retracement, expansion, retracement, expansion, retracement, then our expansion, then the retracement, and instead of going for more, they fell all the way, then falling down. And make it bigger now, so that you really appreciate it. This is the power, and if I hide the chart, this is how it looks. The expansion, retracement, expansion, retracement, expansion, retracement, expansion, retracement, expansion, the retracement leg, failure in forming a new high, and then reverse that retracement leg. Reversing that retracement leg, this from here to here forms our daily range now. We expect a retracement into it, and then that. If you are not satisfied with that, this, you can wait for all these being gotten out here. That forms a market structure shift. Look for your bearish operators here that will send you to start looking for all these lows if they want to go down to that extent. All these lows. And that is exactly what he did. Going down all the way to look for all these lows with that. So, after looking for all these lows and taking out all these lows with this, which is with this, something like this, coming all the way down, forming something like this, equal lows, and then after taking out all those lows, here, this is something that should even jar your head. Equal lows. Look at how support and resistance traders will get smoked. The market came to this particular price level and bounced. Coming back there again, and then we see something of a bounce. Support and resistance traders, seeing this, they can start taking longs here, thinking we should get to this resistance here, they sell off. Or we should go higher than that. This is it. Look at how clean this is. Look at how the market came to gravitate and take it out. Clean their clocks out here. After cleaning their clocks, then going the way. And then there are another type of traders, they also get their clocks cleaned here. Breakout artists. When they see these big down moves, they would have placed a trade under here that, once this break down out, then they will be placing a sell trade here that it should keep going down more. They'll get their clocks clean too. Once you place the trade here to go down a bit, they'll first be in slight profit and then they go get their clocks cleaned. And then look at the amount of bullish liquidity pool that will be here. Bullish liquidity pool where smart money will come here, pair their buy orders. Those that are putting sell stops here, those that are taking trades here, putting sell stops here, and those that are placing sell orders, breakout artists, placing sell orders here. How do you all get their clocks cleaned? In the sense that smart money, if they are even in trades here, if they are in sell trades here, they can close their trades here and then pick up, buy all those sell stops, buy them up, and then go back. Getting their clocks cleaned. And now we're getting to the phenomenon that happened in 2024. Going from here, you have been having successive weeks from July 2023. You had successive weeks where the market was just 100% printing bullish candles, and this was the target. I'm so serious right now. I expected this target when we were getting here. I was pairing this up that okay, we should see here. I expected this to be a point of rally. They rallied. This was the expectation. Seeing those highs get smoked out. They did. And then I was expecting this final high to get smoked out. They got so close to it and then they failed. How was I able to escape the whipsaw? Part of what I'll be teaching next to be fair value gaps, how to know whether they are still valid or they are invalid. Good. After the market made this to show all of this market structure shift, this has been up, then you would have expected a retracement, then more down moves, but the market changed to bullishness, so an uptrend, and then MSS occurred here. After MSS occurred here, the market tried gravitating all the way here. They failed and then retraced. With this, I was expecting this target. This and this, from here to here, from this particular point to this particular point, becomes my daily range. This sell side, this buy side. This becomes my daily range. So anything that happens here is within this range. So when the market started giving up the ghost, they fell all the way, retraced into deeper discounts. Essentially, this is what they did. The market went up here, formed a new low, retraced a bit, took that out, then market structure shift upward. This is the retracement leg, and then I would have been expecting maybe something like this nature. That would have been it. Now, got as high as here. This is where I'm expecting, this is a liquidity point I'm expecting for them to take out, a buy side liquidity here. And then they retraced all the way down. They didn't get to this sell side liquidity. So as of the point that they didn't get to this sell side liquidity, I'm still 100% confident that they can still go back. They can retrace all the way to discount level, deep discount, very deep discount, retrace even up to here, and then bounce. And I think they almost did here. Retracement down here, and then they tried going back up, failed again. There's liquidity here now. There's another liquidity here that hasn't been gotten. When this one failed, so this is 1, this is 2. Support and resistance traders will be seeing this and start drawing stupid lines like this. Sorry for me saying stupid lines, but it's somehow. Start saying, oh, this is a trend line resistance. So when it gets close to here, it should fail again. And then they will be expecting this should be what should be taken out. I don't know how they feel about that idea. The market doesn't just follow lines. All these lines I'm drawing here is just to highlight tops and lows and highs. You don't see me drawing trend lines to show you anything. So after they failed to take out this again, there are traders, let's say long-term traders that have sold from this point or sold during this move, expecting this low. Their stop loss will be here above this. If you don't believe it, that's how majority of traders, almost 90 to 95% of traders trade. Stop loss is always above an high. And I'm not saying it's wrong. It just depends on the context. Also this point, there are some traders that sold from here and they're expecting maybe this sell side liquidity to be taken out that hasn't been taken out. So their stop loss will still be above here. So there's accumulation of stop losses here. There's accumulation of stop losses. And then this also failed and then sending us down. I also participated in the sales going down here because there are things I saw that I was like, yeah, it should keep going down. I also participated in the sales going down here. You can check out the weekly outlook that I did, although I stopped for a while because of the mentorship. So that you just get what I'm saying, not that you just be watching weekly outlook and not understand. But I'll resume back. To doing that. So those that I also participated in these sales, but I also kept the premising I don't want this to be seen, because if after there's this market structure shift here going all the way up and then coming back down to take out this particular sell side liquidity, I'll be thinking maybe this is more of a reversal move and then we start seeing this low, and maybe come all the way down. So with that being said, I didn't expect us to go all the way down, but if it had happened, I would have also traded accordingly and not printed the candles. So, and then we start seeing dollar start joining back up. This is what I did before. Dollar start joining back up. Now, if we are going to say this failed, that this particular one, this leg, let's call it a price leg, that means they should retrace all this going back up. They should retrace into premium, right? Let's just put that gimmick in our head. They should retrace into premium. Simply retracing into premium, that means we should see this. They should enter into here, retrace, then maybe dump more if they want to. So with that premise, I followed them on a long here. My bias here was, okay, let's see longs. They took this out. That was the blue line I drew before. They took this out. Taking this out, I was like, okay, do we want to see this? Taking that out. This fair value gap here failed to stop us. So since that fair value gap failed to stop us, this was the next thing. It also failed. They entered this fair value gap. Immediately it failed. My eyes is now gravitated and glued to. We have taken out this daily range, this external range liquidity of this particular daily range. This the next. This the next. So I'll be having a bullish bias to do what? To go for this in the subsequent week. But that doesn't mean there won't be times when even within this price leg, when I'll be having bearish bias, because they might want to feel an imbalance, like this fair value gap that may at the end of the week be formed. They might want to feel it out and then go. That means coming all the way down there and then going for more. So I also look at the lower time frame to see that. But this is how I draw my weekly bias. And it's always good to always hang on to low hanging fruit and don't be 100% stuck on a bias. There are times when you make a mistake and then you'll be wrong in your weekly bias. And then if you are stuck to that, you are right, you're always right, then you keep trading and losing. That's the way, I think the simplest way of actually teaching you, the simplest way of you actually approaching trades is have a weekly bias. Know why your weekly bias should go there and then trade according to that weekly bias. So each day you just analyze it. After having a weekly bias, you just analyze the daily time frame to see, okay, is it conforming to my weekly bias? If it is, then you trade according to that on the lower time frames. And if your weekly bias is bullish, then you only take bullish trades. If your weekly bias is bearish, okay, to meet a certain liquidity point, you only take bearish trades. Let's say for the last week, I had a bullish bias, so I was targeting, let's see this first, and then this. And then when we start gravitating there, I will only be looking for bullish trades every day. Bullish trades, bullish operators. To gravitate upwards, I will only be expecting to take trades that will send prices upwards. So that way I have streamlined my thoughts for the week that, okay, till we hit this particular liquidity point, I will be looking for bullish trades for the week. With that being said, let's now also go to the daily time frame now. So looking at the daily time frame now, I will expect each day to keep giving me longs. I will keep trading longs. That's last week's trading. That's what I'm trying to explain. So one of the places I'll be expecting long, this is Monday, Tuesday, Wednesday, Thursday, then Friday. So there are two ways where I'll be trading this. I can trade longs and target the previous trading day's high. If I'm expecting the market to keep gravitating upwards, that means they'll have to be taking out the previous day's high. That would be like a first form of liquidity target for me. Previous day's high. So when the market, this is the Monday candle, when the market opened here, I only look for trades that will extend here. And then you can take trades that, you can look for trades that will get to the previous day's high. When you get to the previous day's high, you close up and you are done for the day. That's something. or you can look for trades that will extend all the way here. Why all the way there? Because of from here to here is a leg, the retracement part of it. So you expect another leg, right? Since you expect another leg, they have done the retracement part, so you expect this. The buy side liquidity here to also be taken out. That's also another drawn liquidity you can have here. The easiest low-hanging fruit that I would advise beginner traders is just look for the previous day high. It's easy. If you're expecting longs, that the week should go long, and then you are targeting, you have a drawn liquidity for the week, and then you expect the daily ones to just be going longs, then target the previous day high. Once you target the previous day high, when this is Friday, this is Monday, once they take it out, you are done for that day. You don't have to take the majority of the other moves for the day. Just take that, you are done. This will build confidence. If you can do this very well, then you can even anticipate this later. And anticipating this, you can take like the majority of your trade, the bulk of every of your trade at the previous day's high, and then wait for the little that remains. You hold out for this. If you get it, fine. If you don't, then use that as a learning curve. And this will boost your confidence. So, same thing with the next day. With the next day, the market opened here on Tuesday. The target will be what? Again, the previous day's high. From where the market opened to the previous day high. Simple. You get that, you are done for the day. When you get advanced, you may target this, but for that, you are done for the day. And we are marching towards a particularly drawn liquidity, the buy side liquidity here. Simple. With that being said, you have gotten to trades. On Wednesday's trade, you target again the previous day high, looking for bullish structures to send you to the previous day high. Just waiting for that. You see, the market opened, went down, came back higher, closed higher. Previous day high. Get it, get out. You're done. Then on Thursday, there are times when you might not get any trade with the previous day high. Trades are when the close is so closer to the previous day high. Before you might impute a trade, they might have already done it before London session or New York session. They might have done it. So that day you can just sit down and just watch how the market evolves and how price evolves. And if you're a bit more advanced, this would have been anticipated. There are a series of fair value gap that has been dropped there. So, with that being said, on Friday, yes, this particular one, you are still on a long, you are targeting, what did I do? You are targeting a previous day high. Look for your bullish operators. If there is none, then sit your ass. If there is no bullish operators that will confirms to send you for you to pick a trade, to send it here, then you sit your ass down. And I'm going to open this Thursday and Friday up for you to see. All these retracement back, if you're advanced enough, this is what I was trying to draw before with that rectangle. There's a fair value gap here. And get to the lecture on fair value gap here, you're going to understand it. There's a fair value gap here. So the fair value gap here, in our advanced lectures, I'll tell you how to pair it. And this is why they depreciated here. We are still targeting here and here. Remember on the weekly. So this will still be like a frame for me. We have still look for longs. Like what happened yesterday, target the previous day high. Then today, that's still my target in the previous day, and then like that till we get up to here, and then this next one here. So that's how I pair liquidity in forming a bias. That's how I use liquidity to form bias. So it's not that I just pick out my bias from thin air. They must have anchors, things that are guiding it. This is my drawn liquidity on a higher time frame, and since this is my drawn liquidity on a higher time frame, so if I'm stepping down a bit, that should be where I should trade towards. So that's it. Unless maybe there's an imbalance that I'm expecting them to rebalance, that is it. But without that, I trade according to the drawn liquidity. I find my trades, I simplify everything according to the drawn liquidity. So that's it, guys. See you next time, folks. Have a lovely day. And then we also have another class. Where I'll still take you down to the lower time frames. That will be a live stream session on Saturday. We will also break it down to the lower time frame, down to the 1 hour, to the 4 hours, to the 1 hour, to the 15 minutes, the 5 minutes, and even up to the 1 minute chart, where you see how I use this to pair my trades. So, see you next time, folks. Have a lovely day.